Let's answer some questions from Sunday's Market Outlook. And I'll do, I think, 6 or 7 this week. And I'll touch on some from the crypto segment that I put up. I also put that out as a separate video. And great discussion, really. You have those who are clearly on the side of crypto who felt that, I just didn't get it, but didn't exactly say what I didn't get. And then you had those who are sort of on my side, which are skeptical that it's anything more than today's version of a tulip. But we will answer a few there. I went through the questions, a lot of good ones, but I just can't get to them all. So I got to some that are representative of a bunch of other questions. And in answering some, I think I'll be able to answer some of the others. This first one I think is important. Don't you think that a PE ratio of 15-16 belongs to the past or is obsolete? And that has been a growing conversation, that given the nature of the type of companies that are in the index today, that it is more growthier than value, and the economy is more growthier than it was, let's say, 70 years ago, that it probably would have a higher multiple, and that maybe PE is not the right thing to look at anymore. Maybe the PE is, a ratio that belongs in the past, and we should look at some other metric of value. I don't know what the answer to that is. These values were tied to GDP growth rates exceeding 3%. I don't know that I would tie it to the growth rate. I believe the paradigm has shifted in 22, 23 could be the new normal, given the more moderate U.S. growth rates of 2 to 3%, which are far lower than the spectacular growth rates seen in the decades from the 50s to the 80s. Any thoughts? So at first your comment seems paradoxical. You're saying in the past growth was much higher and much stronger, so you could have lower valuations. People weren't willing to pay as much, but with growth really low right now, people are willing to pay more. It sounds almost paradoxical, but it could be that you're relating it to the growth of opportunity. When you have an economy growing very rapidly, a lot of opportunities are showing up. There's less competition for investment. There's lots of places to invest, so there's no concentration of investment. Maybe you mean it that way. Let's look at the competition argument. In 1952, 4.2% of the U.S. population owned stocks. By 2024, that is 62%. That's 4.2 of a much smaller population. So just think of the sheer number of people. Because from 1952 to 2024, not only did the population increase, but the proportion, 4.2 to 62%, increased as well. So that's a lot of competition for assets. Now, to be fair, the number of investment types has also exploded quite a bit as well. The number of markets that are open to U.S. investors has also increased dramatically as well. The number of different types of derivatives and securities that you can invest in. Look at the whole crypto space that didn't exist before, right? Well, that is competition for all of that investment. But with the sheer amount of wealth creation in the U.S. over the last 70 years, it is probably the case that the avenues for investment haven't increased at the same rate, thereby increasing the competition for these assets, thereby driving the price up. You could make that argument. 1952, if we go back to that period of time, the reason I use 1952 is because I Googled what stock ownership was, and it just so happened I found a link that just referred to 1952. It's not that it's interesting for any particular reason, but there it is. 1952 in the U.S., you're really relying on domestic growth. Soviet Union still existed. There was nothing there. Japan was really nothing. China was really nothing. South America was interesting for some oil and maybe a little bit of textiles, but the rest of the world was really, other than Western Europe, there really wasn't much choice in where you could go. And the banking system wasn't as advanced today, so you didn't have the type of online trading and the ability to invest all over the world. You pretty much relied on domestic growth. 2024, U.S. companies can tap into global growth. They can tap into growth anywhere it happens to be. and not only tap into global growth, they can skim the growth market by saying, we're going to take away the high growth segment of all the markets because the highest concentration of tech stocks are still the US, right? And from about 2005 onwards, a lot more tech companies started seeing increasing returns to scale. There was, in economic theory, this belief that, let's say that this is size, and this is the cost per unit. That as you started to grow bigger, you could drive down the cost per unit up to a certain point. As your size increased, your cost per units would start to increase. If you've had a nice solid undergrad in the business school, you've had to sit through an economics class, you'll recognize that as diminishing returns to scale. Well, now we have increasing returns to scale where the bigger you get, you start dropping you continue to drop down. There is no minimum point. You continue to drop your costs down such that as you add each incremental user, they're almost free, especially with companies that have network effects. So this would speak to the justification for a higher multiple. This speaks to, well, what else are you going to do? Everyone's fighting for the same group of assets. It is going to drive the price up. Maybe you don't want to pay that price, but listen, if a house is selling for $1 million and you don't bid on it, you're not going to get it. There's no point waiting for $600,000 anymore, right? So that's this argument here. Another one is the declining share of labor in income. And we know GDP is roughly equal to gross national income because of the identity that aggregate output equals aggregate expenditure equals aggregate income. That is an economic identity. So if labor's share of income is declining, the economy is much more scalable because technology is scalable, capital is scalable. Whereas if you got to keep throwing people at the problem, well, that's not very scalable. Eventually you run out of people. You limit the amount of return a company can have. But if a company could double its revenues and only increase its labor force by 10% by leveraging capital, you have much higher growth rates and much higher levels of profitability. And again, the US is the most, I wouldn't say technologically advanced, but as far as companies go, the most technologically concentrated in terms of home. So short answer, yeah, there is a good justification of why 22 and 23 might make more sense. And given increasing returns to scale, given the declining share of labor in income, maybe the PE ratio isn't telling us everything we need to know and we need a better measure instead of a forward multiple of just earnings, right? Cloud computing companies, cybersecurity companies are showing us that earnings don't really measure much because you spend a lot of money to get a customer that spends money over years. And earnings are not capturing that. The PE is the wrong ratio to look at. That we should be looking at some multiple of free cash flow. Maybe that is a better multiple. Maybe that has been more stable. So for some of you that are research-minded out there, maybe you can figure that out. Or maybe it is competition. Maybe you have a time series of the growth of wealth over time and the growth of investment opportunities over time, and maybe the growth of wealth has outpaced the growth of investment opportunities, thereby driving up the price of all the investment opportunities. It is not a question that has an answer. It's a question that sets up a rich intellectual debate about exactly what is wrong. Is the PE the wrong measure? Is it competition? Is it the nature of technology versus labor today? Lots to unpack there. I think what we can say is that a company that is not technologically scalable, that relies more on labor, that has increasing returns to scale, probably should not be trading at 22 and 23, probably would be better suited here. So maybe it's a company by company thing we're doing. How do you think the impacts of government spending cuts could impact the market? More cuts, larger unemployment numbers, more 401k withdrawals, market compression. Yeah, there's a pathway there. Everything has a trade-off, right? So if you have spending cuts, if it's met with tax cuts, you may balance out. So you may say, okay, well, we'll stop spending $1 billion and we'll stop taxing $1 billion. Well, great. Instead of this group of people over here getting the $1 billion, this group of people gets to keep their $1 billion. The question would be which group has the higher velocity of money to determine what the impact would be. If this is middle class tax cuts, I think you'd get the same velocity as giving transfer payments to lower income people, because middle class in America does tend to spend pretty much every penny that it gets. Its marginal propensity to consume is about 95, 96%. And that is assuming forced savings, because you have Social Security, which is a form of forced savings. So if you have a balance, you're good. But what if your tax cuts, your spending cuts are greater than your tax cuts? So you say, well, we'll cut $1 billion in tax, but we're going to stop spending $2 billion. Well, this money going out was somebody else's income. So $2 billion in income or revenue are not going to happen, but $1 billion in savings in taxes will happen. Net effect is you're taking $1 billion out of the system, and if you have a velocity of about 1.8, you actually take 1.8 billion off of GDP. Now that's only $1 billion. Try $1 trillion, because we're talking about 1.8 trillion on the deficit. So take $1 trillion out at a velocity of 1.8, you're taking 1.8 trillion off of GDP. That's about 6% of GDP. That's about all we're running right now, is about 6% nominal GDP. So if you actually get something like that done, if you balance the budget, you have a zero growth economy, right? Because the deficit is primarily made up of transfer payments, which shows up in C or I, consumption or investment. So even if you ignore the G component of GDP, most of the federal budget is in transfer payments that show up in C or I. If you take 2 trillion out, or take 1.8 trillion out, you take away about 6% of nominal GDP, which is about what nominal GDP is and has been for the last 4 or 5 years. If you go back and you balance the budget in all of those years and take out the deficit would be in transfer payments to C or I, take it out of C or I, you'll find that the US has been a no-growth economy for 5 or 6 years now. A no-growth economy for 5 or 6 years now. Interesting, right? So it depends. It depends on the trade-off, right? Spending cuts versus tax cuts. If you put back into the economy as much as you take out of the economy, in terms of, look, we're going to take all of these transfer payments out of the economy, but we're going to put all of these tax cuts back into the economy and they equal, then, it's just a matter of, well, who was receiving the money? How were they spending it? Who is now saving the money in taxes, and how will they spend it? That's sort of an unknown, but it would be more balanced. All right, this is a rather long one, 4 questions, but it does all center around the same topic. To sort of set this up, we have to understand that the Fed is operating in what's called an ample regimes framework. So let's take reserves. And reserves, when you get a lot of reserves, it flattens out at the long end of the curve, so that if you, this is the amount of reserves, the quantity of reserves, and this is, we'll just say simple, let's call it the interest rate without getting into too much detail. If you have just enough reserves, you have a downward sloping curve, which means if you change the interest rate, the level of reserves will change. If you don't want the level of reserves to change, you have to engage in open market operations to always adjust the level of reserves. In an ample reserves regime, if you change the interest rate, because you're on the flat part of the demand curve here, the level of reserves does not change. You're also paying some interest on reserves, so that if you raise the interest rate, you also raise the interest rate you pay on reserves. The curve always looks like this, right? So you don't have to step into the open market to manage reserves when you have an ample reserves regime. You just have to pay interest on reserve balances so that you have a flat demand curve over here. So with that, background in mind, let's answer these questions. When the Fed is heading towards the reverse repo plus reserves minus whatever's ample equals zero as a result of U.S. Treasuries running off, which is what they will do. That's why we watch every week the level of reverse repos, because once this hits zero, the reserves start dropping very quickly. This means the Fed is under pressure to increase the supply of reserves by buying assets to maintain the ample regime. Well, not so much increasing the supply of reserves. They're not going to increase. They want to try to hold it constant. So they have a balance sheet with a whole bunch of treasuries on here. And as these treasuries run off, reserves will decline, which means they would have to buy treasuries in the amount that they're running off to stay in the ample vicinity. So it's not like they're stepping in to buy to increase, is they're rolling over and buying whatever's maturing. So if 30 billion mature this month, they'll buy 30 billion more to keep reserves constant. One would expect this to increase demand for bonds. Yes, you're right. Can we say that as it approaches zero, it becomes more likely for yields to come down due to pressure of staying in the ample regime? Well, I don't want to conclude that yields will come down. I will say that it will stop the upward pressure on yields because there won't be runoff. The Fed will incrementally be buying more bonds, which would be supportive of lower rates, not higher rates. Having the balance sheet run off is supportive of higher rates. So by rolling them over, it certainly is not going to contribute to the higher rates. Rates still could go higher because the market wants the rates to go higher, but it won't be because the Fed is allowing the balance sheet to run off. It would be it would incrementally be buying more as it runs off. If the purpose of both the reverse repo and reserves is to provide liquidity, it's not so much for providing liquidity, but to remain in an ample reserves regime so as not to have to engage in open market operations. Any reason to think reserves are more preferable to the reverse repo? If so, why? Well, the reverse repo is here such that money market funds with extra money don't change the interest rate target. So the Fed says, well, we want rates to be between 5 and 5.25%. There's the overnight rate, which sets up this is the federal funds rate, which sets up what the overnight rate would be. If money market mutual funds have too much money, they will bid up assets because they want to make money, which may drive the interest rate below the 5%. The Fed would have to step in and do something about that. So what the Fed does is it says to these money market mutual funds, look, don't go hunting around for. If you're going to take anything less than 5%, just come and see us. We'll give you the 5%. So the money market mutual fund has no incentive to bid up asset prices and get less than 5% because they can always get it from the Fed. The Fed does this so that it doesn't have to step into the market and do stuff. It makes the Fed's job easier. Apart from controlling liquidity, it can be used to control liquidity, but it's not really what their initial target or reason is. Is there any reason why the Fed has to conduct open market operations when under an ample regime controlling the interest rate on balances seems to be an ineffective tool? Correct. That's it. No, there really isn't. Apart from controlling liquidity, since I read the rest of the sentence, yes, apart from controlling liquidity, there really is no reason for them to step into the market as long as their reserves are ample. Now, if they start to see overnight rates, SOFR rates start to skyrocket, they will step in and start buying more assets to put more money into the system. Except knowing whether we are in ample versus scarce, what other reason should we care about reverse and reserves and overnight repo? That's it. That is why we watch it. Is if we were in a scarce regime where the level of reserves were managed, I don't know that it would be interesting from week to week. But we are in an ample reserves regime, which means they have to keep it ample. We don't know where that is. Nobody knows where that is, and they feel that they're approaching it, and they're approaching it slowly. but they don't know where it is, and they don't want to find out where it is. In other words, they don't want to keep going until something breaks. You see where I'm going on this? They don't want to find out where it is. They want to get to a point where they think, okay, well, there's no problem here. Should we chance it and go a little bit more, or should we just stay right here? The thinking is that sometime in mid-2025, they'll be saying, look, let's just stay right here. We're good right here. Okay, I'll answer a few that were related to the crypto part of the market outlook. First one, the Bitcoin network of GPUs and the IP code are what back the currency. Let's stop right there. Okay, well then the whole economic infrastructure of the global economy is what backs all the fiat. If we are going to say, well, the network of GPUs and the IPO code, that's basically the highways everything runs on, well then all the highways. You can say the same thing of fiat. If you're going to go to the infrastructure argument, the real economy has way better infrastructure, worth way more money, that is way more productive for a whole bunch of more people, for a whole bigger part of the economy. So that must be the better place to be, right? This is not what's backing the currency. This is what is supporting it. This is the infrastructure that supports it. We wouldn't say that it's backing. When we say it's backing, it means, when we say that gold was backing the dollar, it means you can always take your banknote to the bank and receive the equal amount of gold in return. What can you do with Bitcoin? I take it back to the Bitcoin whatever, and what do I get? Fiat currency. I can only get my fiat currency back. So the only thing backing crypto is fiat. And if nothing is backing fiat, as coiners like to claim, then nothing is backing coins. To say that it is all the infrastructure, you could say the same thing of the economy. The exact same thing, except the infrastructure of the economy is more real and more valuable. Most of Mark's arguments are that cash can be used for fractional reserve banking and Bitcoin cannot. I never said it couldn't. But that would violate, if there was fractional reserve Bitcoin lending, that would violate the hard maximum of 21 million, because you would exceed the 21 million. The moment you allowed fractional reserve Bitcoin banking, you no longer can claim that you have a limited money supply. You now have an unlimited money supply that is only limited by the amount of fractional reserve banking you want to do. This is not true. Well, I agree. You can lend out Bitcoin. Think about MicroStrategy, right? By the way, you should all hate MicroStrategy. I don't know why you don't hate them. I will explain with another comment coming up why all of you purist Bitcoiners should absolutely hate MicroStrategy and demand that it stop what it's doing, but you don't. Because the crypto community is, if anything, one thing they're rich in is contradiction. Let's take MicroStrategy. It has Bitcoin, right? And it has a building hoard of Bitcoin that earns no yield. Well, it could earn a yield if it lent it out, right? So let's say it lends it out. It still doesn't change the 21 million because it owns, let's say it owns 1 million and it lends it out at 3% Bitcoin. That means you got to pay it back with 3% Bitcoin interest. Sure, it can do that. It can turn itself into a lender. I don't know why you'd want to borrow Bitcoin at 3% or why anybody would, other than the ability to short it beyond what exists. Maybe that's what you want to do. But sure, they could lend it out at 3%. That would not change anything. But I guarantee you, if they did that, it wouldn't be long before they say, you know what, this is not bad. Why don't we open up a depository and let other people deposit their Bitcoin with us, and we'll take in $2 million in deposits. And we'll pay 1% because Bitcoin doesn't yield anything, and we'll lend it out at 3%. And they say, you know what? We've lent out this 2 million. It still doesn't change the 21 million. As long as they only lend what they have. They start saying, you know what? Here's something interesting. What if we created a blockchain, and what if we created a token on this blockchain backed by the Bitcoin? So now you have a token backed by Bitcoin, and we'll lend against that. It won't take long before they'll start saying, well, we have 2 million on deposit. Let's lend 4 million. Let's lend 6 million because Well, greed, you got to keep making those earnings. Now you break the 21 million. The moment you go into fractional reserve banking, you can no longer say the supply of Bitcoin is limited. You can't say it. So either the supply of Bitcoin is limited and there's no fractional reserve banking, or Bitcoin does lend itself to fractional reserve banking and Bitcoin is not limited, but you can't have it both ways. That's the trade-off, right? As noted in the video, gold was used for fractional reserve banking back in the day. Bitcoin can be used as well. I agree, but you have to drop the limited argument at that point. Are you willing to give that up? If you give up the 21 million, oh, it's limited, then you give up the value that it currently starts to get, because you have to start factoring in the value of the fractional reserve banking, which debases the 21 million, as you like to say, or as coiners like to say, fiat is doing. You must give up that argument, which means it's not worth $100,000 anymore. It's worth something far less than that. How much? Who knows? Depends on the greed of the bank that eventually sets up and starts fractional reserve lending Bitcoin. Which one do you want? Fractional reserve lending of Bitcoin or a limited supply? Can't have them both. You got to pick one. I agree Bitcoin will not replace the US dollar, but it can be used as digital gold as long as the power stays on. That was a funny one. We'll get to this argument on the next screen, because somebody does ask a question about its intrinsic value. If it's digital gold, it must have some intrinsic value. It must have some intrinsic value. We'll get to that argument, but I never once said Bitcoin can't be used for fractional reserve banking. All I've gone on is the fact that you want to limit it to 21 million. If you do, you cannot have fractional reserve banking, because that is specifically what would increase the amount of Bitcoin in circulation. Can't have it both ways. All currency needs to be backed by aircraft carriers or weapons of some sort. This was somebody had left a comment about aircraft carriers, and that fiat is backed by guns, and because the government has guns and something. But I think what you're saying is that any sovereign has to protect the integrity of their country, with that fiat being part of the integrity of their country. We get that. One cool thing backing crypto is the fact that no single government has full control over it yet. And that gives people faith in it for now. This is a big argument, this decentralized thing, that nobody controls it. Are you sure about that? Are you sure that nobody is even attempting to do that at this point in time? Are you sure it's not even possible? I don't think so. I own some Bitcoin, but I don't think that most hodlers, there is a sort of takeoff of something from the lexicon that I can't remember exactly where it was. I think somebody misspelled something at some point. I can't remember the actual reference. Most hodlers of Bitcoin expect to use it. I don't think most expect to use it as a currency. I think you're absolutely right on this one. I was reading, I think it was JP Morgan's study on this, or it was either, so many good studies out there on who's using crypto and what they're using it for. It was either Bank of Canada. There was three good ones: Bank of Canada, JP Morgan, and there's my brain. You'll get to a certain age where your brain will hold words hostage for no other reason than to laugh at you. And then when you no longer need the word, your brain goes, well, okay, if you're not going to pay the ransom, here's the word. Anyways, they looked at the proportion of the global population using any kind of crypto at all, 6.15%. 6.15%, predominantly men. And here's something surprising in terms of the breakdown in terms of the demographics. Asian, by far the largest. That makes sense. India, China. It just so happens there are more Asians on the planet than anything else. Next was black, which I thought was surprising till I thought of Africa. Next is Hispanic. And then the least white. The least. 6.15% of the world's population are involved in crypto in some capacity. And of that 6.15% of everything they do, transactions are 2%. Trading of the coin itself represents 98%. 98% of what the 6.15% do is speculative trading of the asset. 2% is for transactions. That 6.15 doing 2% is such a small use case. This is not a global solution to anything. It may have specific use cases here and there, but that does not make it mass market. So you have early adopters. You have this thing over here, this crossing the chasm thing. You have early adopters, which I think you've seen. Most of the early adopters are really just trading the frenzy of it and not actually using it for anything very productive. And you have this chasm. There is nothing right now that makes it mass market. Its use case is way too small. As a speculative asset, it is no different than a tulip. It is no different than a Beanie Baby. By the way, Apple TV has a great movie. I think it was out a year ago about the whole Beanie Baby craze. You might want to watch it. I mean, it was traded. It was a currency. It was something. It had value. And there was books being published on, well, if your Beanie Baby was made by this person between these dates, it has this value. I mean, it was crazy. Every generation has its tulips. There is a very high probability that this crypto going on right now is this generation's tulips. That in 20 years, you're going to see a lot of people trying to scrub the internet of their names and try to deny that they had anything to do with this tulip craze, right? These numbers are not interesting. 98% are trading it to trade it. In other words, think about doing this. Say, I am going to build something, this technology, which has this extra feature, and we're going to trade this extra feature and ignore the technology. In other words, we're going to create a whole technology for this extra feature and only be interested in the extra feature, which means it only exists for itself. I want you to ask yourself this question, because I've asked people this question and I get the same answer, nothing. The answer is nothing. If you went to sleep tonight and over the course of the night, God snapped his fingers or her fingers, I think it's a her, really, if you think about the universe. God snapped her fingers, and in the morning, there was no crypto. Would you know? If nobody told you, would you even know? 94% of the population would probably say, no, I wouldn't know. Unless you told me, I wouldn't know, because with 8,000, something like 8,000 to 10,000 different currencies out there, that's 100,000. It probably will be at some point. With 8,000 to 10,000 currencies out there and all those blockchains out there and 14 years of this stuff hanging around, it has not found its way into my life in even the most insignificant way that if it disappeared as I slept, the next day my life wouldn't change one iota, and I'd go on for months and months before somebody said, hey, have you heard? A couple months ago, God snapped her fingers and got rid of all this stuff. I said, oh. If you didn't tell me, I wouldn't have known. Ask yourself that question honestly if you want to understand the value of it at this point. I agree. I don't think most are going to use it as a currency. Very few are actually using it right now, 6%. And of all the uses they use, only 2% is actually transactions. We're just holding on to it like gold. Okay, like a collectible. Oh, I'll agree with that. Yes, like a collectible. Doesn't mean it's a bad investment, though. No, I agree. Does not mean it's a bad investment. But as long as you understand what kind of investment it is, tulip crazes end. And when they end hard. Just be aware of that. You don't want to be the last one with the red tulip bulb saying it's really rare, I promise you, right? It's more calculated and controllable than gold. You don't have to worry about a new mine being found. You see, this would be the thing is I would worry that there is no new mine being found. Right? I want you to think about this, your statement here. No single government has full control over it. because we don't like governments having control over things, even if it's for our own benefit. We just don't like governments having control. What about a private corporation? What if Amazon controlled it all? We know how evil Amazon is. Amazon is the embodiment of evil when it comes to capitalism. The embodiment of evil. Some of the things they do, pure evil. You have to have people in rooms that think this shit up for how they rip off their customer. Pure evil. Amazon, pure evil. What if they controlled it all? Would you be okay with it? Would you rather have a government control it or a private corporation control it? I think with the idea behind the decentralization of the blockchain, the decentralization of the database, that's what that's a big feature of the blockchain technology, is that no one company controls all that data. Well, what if they did? What if a private company controlled all the Bitcoin, or controlled a significant share of the Bitcoin, 60, 70% of it, controlled it? Would you still want to hold it? Probably not. Yet here you have MicroStrategy with a stated mission to corner the market, a private corporation run by a two-time fraudster. That we know of. That we know of. Right? And the market is cheering them on. People throwing their money at this, willing to pay 300, 200, 300% of the price of Bitcoin to help a private corporation control it all. No single government has full control over it, but a private corporation is certainly trying to get it done. The purists of you out there should be dead set against this. You should be protesting this. You should be demanding that they stop. But no, you're cheering them on. Cheering them on. That, to me, seems like a contradiction. Okay, 3 more and we're done here. Combining your skew discussion from the other week with volatility at lows, would it be reasonably cheap to buy SPX put spreads? While volatility is low, it would be reasonably cheap to buy puts. And if they're cheap to buy puts, and you're selling another, or you're buying a put and selling another put below, sure. If you're interested in downside protection, this will cost something. It will. But what could you do to make this as costless or as low cost as possible? It's a good question, and there is something that you can do. So let's think about a stock chart here, and let's do a stock chart going up. There's SPY going up, right? And let's say that you're going to buy a put just below the price. Let's say you're going to buy a 59.50 put. It's at 60, a little over 6,000 right now. You'll buy the 59.50 put 3 months out. You expect that sometime January, February, the market will see what Trump is doing and say, hey, hang on a second, he's settling old scores. He's not working for everybody. And you might get a little bit concerned. The market gets concerned and down it goes. Or maybe he throws these tariffs on day one. It just ends up being an ugly scene. Who knows? 59.50, you're going to buy a put. This, if we draw out the distribution here, and what I'm going to do is, we've read your question. Actually, let me just, I'll just write it out on here, okay? So this is what the distribution looks like. And actually, we can go like this, right? So when you buy the put, you own everything all the way to 0. Is it going to 0? No. Then why would you want to own the whole distribution from 59.50 down to 0? It's clearly not going to go to 0. So when you buy the put, your first job is to think, well, what kind of correction do I want to protect myself from? Another way of looking at that is, let's say I don't buy a put and the market corrects. I got money sitting on the sidelines, the market corrects. How far down would it have to go before I say, okay, I'm willing to commit money at this point? You might say, well, a 10% correction. I'm willing to jump into the market on a 10% correction. So it corrects down to 5,400, right? So you'll buy the put at 59.50. You can sell the put at 5,400. You get the spread. But if you were going to jump into the market at that point, sell 2 puts. So you will buy 1 put up here and sell 2 puts down here. So if this cost you $3, go down until you find a put for 150 and buy 2 of those. And that is where you're agreeing to enter the market. it's where you would say, I'd enter the market at that point anyways. If a 10% correction to you would be an entry point, go ahead and sell another put there. The 2 puts will help offset the cost of the 1 put. That's a fairly inexpensive way with volatility this low to protect yourself. Another way to do it is simply buy a put. Just buy a put. And if the market starts going down, you can then sell a put for a lot more money than you could sell a put at first. You buy the put, and then you let the market tell you what your next move is going to be. And if it keeps going down, you could probably sell another put even lower to pay for the put. But if you want to do it all on day one, long 1 put, short 2 puts at where you would enter the market on a correction anyways. Okay, I wasn't even going to answer this one, but I did have this conversation today. Believe it or not. What will the value of my labor be when AI and robots can do things better and faster than me? Maybe we need a new way to measure value in money. No, we do not. Look, all sorts of things can happen at the micro level. You cannot make policy at the micro level. You must make it at the macro level, understanding that there is a distribution in the population of all sorts of things. Everything has a distribution, including the value of labor. Some people have invested nothing in improving the value of their labor. Some people have invested their whole lives in improving the value of their labor. But you must govern to the middle. You must govern to the middle of the distribution. You can't just say, let's just make things easy for these people. And you can't say, let's set all policy for these people, because that would be a very expensive economy that you would be in, because you'd be carrying everyone. You have to govern to the middle, understanding that your goal is to move the distribution this way, is to move the distribution that way. The greatest good for the greatest number does not mean everybody wins, right? But that's the goal. The greatest good for the greatest number. Why? Because in a complex system, you live with trade-offs. You can't say everybody wins. That's maximizing. You can only optimize. So we set policies, the greatest good for the greatest number. Will there be losers with AI and robots? There always are. Any new technology, there will always be losers. Always be losers. But there'll be many more winners than losers. Because if you think about technology from the beginning, let's go back to Denmark and the looms that would weave textiles. That was seen as, that'll get rid of all the jobs. And it actually didn't. It increased the amount of jobs because it created an ecosystem that wasn't possible otherwise, because you had a whole bunch of people weaving, producing a little bit of output. You add a bit of capital to them, that output increases, suddenly your markets increase like they've never increased before. So now you have merchants, now you have transportation that didn't exist before. You have a whole bunch of ecosystems that open up because of that one thing. Did some people lose jobs here? Yeah. Of course they did, but much more was created. You have to look at it at the macro level, not the micro level. AI and robotics. You got to think about, well, what kind of ecosystem can it create? AI. So we have Tesla working on a robot. Much like Apple worked on an iPhone. What did it create? A whole ecosystem of apps. All the app developers, all the apps that could possibly show up here, and the business models that could show up, because now it's app-based, that really had no sense before or didn't make a lot of sense as a website a destination, suddenly were great as an app. Made a lot of sense as an app because you now have the phone. Well, that is an iPhone. Think about all the apps that can be created, that could be downloaded onto this, all the functionality that could be downloaded onto this, all the different languages, all the different voices, right? I mean, we have ringtones, the most useless thing in the world, really, but there was a big industry on ringtones. You can download all these ringtones. Well, what kind of voices can you download? Right? What kind of rapid eye blinking can you put in there? What kind of swear words can you download? Because I tell you, if Apple made one of these, there'd be no swear words. But maybe you can download an app that allows the robot to swear like a drunken trucker, right? Think of the ecosystem that can be created with just that one thing. Think of the industries it could open up that otherwise would never ever exist. The creation of the electron microscope made the whole biotech industry possible, right? Think about what one innovation can open up in terms of the size of industries that can be created. On net, this is an argument I've heard that, not just I've heard, but that has shown up through the history of the innovation literature, is resistance to technological change because it's going to destroy jobs, it's going to destroy the economy, there'll be unemployment, everyone will be on the streets, the machines will be running everything. No, that is not the case. It will produce the greatest good for the greatest number. It will open up industries that were never possible before. It'll open up businesses that were never possible before. How do you clean this thing? Right? It's going to get dirty. It's hanging around the house with kids. It's going to be outside. It's going to get dirty. How do you clean that? Well, you're going to have cleaners. Maybe, you have people who come to clean your house. Maybe you'll have to have every 3 months a company come in that will clean your robot because it has to be cleaned a certain way. There's certain chemicals that you need. It has to be maintained and serviced. Its rotors and things like that need a certain type of oil. You're going to have a whole industry of that kind of thing. So no, I think with AI and robotics, the interesting thing is what will be created. I want you to think about the challenge universities have had for some time, especially computer science, engineering, all of those disciplines, is they have to start thinking that they are training students for jobs that currently don't exist on technology that currently has not been invented. What in 10 years will be the hottest industry associated with AI? Will it be apps? Will it be servicing? What will it be? What training would a university engage in now for where that will be in 10 years? Training for jobs that don't exist on technology that hasn't been invented. That's how you have to think about the future. Last one here. This is an argument I think you want to try to avoid. For Bitcoin to reach 100,000, there must be some intrinsic value to it that we don't understand. Else, what is the justification? So let me say that a different way. And if we say, yeah, hang on a second, for it to be 100,000 with everybody there, all these people, somebody, they must collectively know something. Somebody must know something. Maybe I don't know it, but can I not just take the efficiency of the market as given and say, clearly there must be something here. All information finds its way into prices. Clearly there must be something here. I think that is your argument. Let's make it a ridiculous argument now using the same structure. Okay, we're just going to make it a ridiculous argument. For Scientology to reach 100,000 members, there must be some intrinsic value to it we don't understand. Must be true in some degree. You can say that of all religions. For Catholicism to reach over 1 billion people, there must be something to it. There must be something. God must be real. All these people can't be wrong. If we believe in efficiency, it must be that it's true. Some of those people must have some evidence that this is true, and right. So you can continue on with those kind of examples. Technical analysis is used by a lot of people in this industry. A lot of research shows that it's 50-50. You can flip a coin and be just as good as any technical analyst. Just flip a coin, and you don't have to spend 2 years studying the stuff. But it has power because a large number of people believe it's true. So if they see a chart that looks like this, they'll say, aha, double bottom, there's support. And they will begin to act as if that is true, thereby giving some effect in the real world. That is all called extrinsic value. I'm not going to argue that Bitcoin does not have value. It has extrinsic value, but it has no intrinsic value. Because again, I want you to imagine that you wake up tomorrow and the blockchain, just assume you have no investment in any Bitcoin, that you're not invested in it in any way whatsoever, just your normal life, never mind investments, just your normal life, that Bitcoin disappears overnight and the blockchain disappears overnight. You wake up the next day, and if nobody tells you, how long would it take you to figure out, hey, wait a minute, something's different here? I'm betting that for 94% of you in the world, it would be weeks before you came across a headline going, when did this happen? Bitcoin is gone? Blockchains are gone? When did this happen? None of you would even know. None of you would even know. That's how you can sort of start thinking about the level of intrinsic value. Now imagine you wake up tomorrow and the internet is gone. How long would it take any of your lives to be affected? Almost immediately from the time you get up. Almost immediately from the time you get up, you would notice it right away. You wouldn't have to be told. You'd be trying to call people saying, because you'd have to use the telephone now, hey, what happened to the internet? What happened to the internet? Now I want you to imagine that you wake up tomorrow and all the utilities in the world are gone. You'll notice really quickly. What about all the cell phones? They all disappear. Doesn't exist anymore. The telecoms are gone. There's no such thing as cellular service. You'd notice right away. All of this stuff you'd notice right away. Bitcoin's been around on blockchain for 14 years. And 94% of the world wouldn't even notice if it disappeared overnight. And of the 6% that use it, it's only for investments. They'd only lose their money in investments, be pretty pissed off. But the operation of their life would go unnoticed. That if they didn't check their portfolio and they just went about the day, they probably wouldn't even notice that it didn't exist any longer. Only 2% of the 6%. Only 2% of the things that the 6% do would notice. It has a lot of extrinsic value right now, and I think a lot of people are attracted to it and say, I don't really know what it's useful for. I don't really know what the future is going to have, but I do know it's 100,000 and it's going up in price. I'm in. Which means they're part of that growing 6% that are using it as an investment. That being said, you do not have to believe that it has intrinsic value to recognize that there is an investment opportunity here. I live in an area that is flat. We're in Canada, at least. In Costa Rica, I got mountains all around me. Here it's flat. It's all farmland, and farmland is being developed. But let's say that there's this piece of farmland over here. It's in something called the green space, which cannot be developed, and the green space goes on and on and on. It can't be developed, and a bunch of people start heading to the green space saying, there's gold in there. There's a ton of gold in these farms. And I think, yeah, freaking idiot. There's no gold here. First of all, there's no rock structure. How stupid can you be? But they're coming and they're coming and they're coming. So I'll set up a store and I'll sell them all the equipment they need to go and get the gold. I don't believe there's gold at all, but I believe there are people showing up who want to mine for gold. Do you get that? So I don't mind setting up something that makes money off the crowd. So the argument of, well, what about BlackRock and all these companies? What? They're all confused? No, they're the casino. What they see out there is they see a whole bunch of people who think that this has some value and who want to trade it. So, okay, you want to trade it? Here you go. You can have this. Yeah, we'll give you products. But they don't really care whether you make money or lose money. They don't really care. Because that's not what they're there for. They don't have to believe in it to service you. Now, if they're going to service you, the last thing a casino is going to do when you're walking through the doors and say, the house, it's all rigged, the house wins, you guys are all idiot. They're not going to say that. They're going to say, we got great shows for you, great food, there's free drinks while you're playing. Hey, our jackpots are paying out like you've never seen before. They will tell you what you want to hear. No casino will put people at the door that as you're walking in will inform you will say you realize, of course, the odds are against you. The longer you play, you're going to lose. We always win. We're the house. We water down your drinks, by the way. And if you attempt to use your brain to count cards, we'll catch you and throw you out. You can't win. You're a loser. No casino will ever tell you that, but every casino owner knows it. Every casino employee knows it. Every blackjack dealer knows it. Every pit boss in there knows it. Everybody knows it. But they're not going to tell you. Now, there's a lot of people in the crypto space that believe that there's nothing of value here, but they're not going to tell you. Why would they tell you if they're setting up the casino for you? They will tell you exactly what you want to hear. And they'll claim, I didn't misinform anybody. I simply reinforced the existing level of misinformation they showed up with. I just didn't inform them. It's not my responsibility to inform them of anything. I just reinforced their level of misinformation. The king of reinforcing misinformation, Michael Saylor. Most of what he says is absolute misinformation. Absolute misinformation. Now, if there was intrinsic value, he wouldn't need to do that. He wouldn't need to do that. If there was intrinsic value at the casino such that you could win, that the crowd could win, casinos would be out of business. The crowd must lose. Now, in a casino, are there some big winners in there? Yeah, millions of losers, but a couple of big winners. Will there be some big winners in crypto that are part of the crowd? Yeah, but millions of losers. Millions of losers. Look at my screen. Look what I've done. Somebody said, what are you writing on your screen for? It turns into a big mess. There was a football commentator who would do this as well. Madden. Yeah, I'm the Madden of finance. Anyways, that's it.